Hi, my name is John Dutemple. I'm a chartered financial analyst and president of Compton Advisors LLC, a registered investment advisor firm in St. Louis, Missouri. You're here because you have questions about financial planners, and I'm here to answer some of those questions. The big question, of course, is what can a financial planner do for you? The average investor, left to their own devices, only captures a fraction of the returns that the markets themselves achieve. Financial advisors help the average investor close this gap. How big is the gap? Each year, the performance evaluation firm Dalbar looks back 20 years at mutual fund activity to determine how the average investor has fared and compares that to the markets themselves. The results are astonishing. For example, the annualized return for the S&P 500 for the 20 years ending December 31st, 2013 was 9.22%. The average investor return, on the other hand, over the same period was a mere 5%. That's nearly 4.25% annual return left on the table. What does that mean in real dollars over 20 years? See for yourself. The average investor would have had over double the money if they'd just invested in the index and walked away for 20 years. Instead, investors are trying to beat the market, timing the ups and downs, paying 1% or more in management fees or 5% in sales commissions, chasing last quarter's winners just to eke out a percent or two above the market, all the while leaving half their return on the table. As the slide states, only a quarter of managed funds manage to beat their benchmark. The track record is slightly better for value funds. Chasing the previous period's winners produces even worse results, as performance tends to come back to the average rather than follow above average performance with more above average performance. What is the reason for this performance gap, and how can an investment advisor help you close it? Most of the shortfall is produced by three things: fear, greed, and unexpected expenses. The first two, fear and greed, produce counterproductive forays into market timing, essentially buying high and selling low. Fear looks something like this. Market crash! Sell! Sell! Unfortunately, you're too late at that point. On the other hand, greed looks like this. The market's doubled! Buy! Buy! Again, too late. These cognitive biases are not uncommon. Your recency bias tricks you into thinking if the market has fallen, it will continue to fall, and if it is on a tear, it will never go down. Couple that with CNBC and Money Magazine screaming bull or bear, and it's no surprise that many investors lose their nerve on the way down or their sense on the way up. Advisors help by assessing risk tolerance, risk capacity, and your need for risk to keep you out of markets you can't handle in the first place, and by supplying rationality, perspective, and objectivity in place of emotion, biases, and gut feel, giving you supported information you need in turbulent markets. It's yet to be seen if robo-advisors can provide this sort of guidance when it's needed. Advisors work with you to develop an investment policy, implement that policy, and stick to the policy through turbulent times, including objectively rebalancing your portfolio in the face of moving markets. The other threat to your investment nest egg is unexpected expenses or drops in income. These can come in the form of truly unexpected events or just inadequate planning. Advisors work with you to build moats around your investments from the infrequent but inevitable expenses, such as saving for a car, budgeting for home repairs, as well as the improbable but catastrophic events, through life and disability and other insurance and an emergency fund. Talk to an advisor to get your money working as hard as you do. Where can you find a fee-only advisor? Well, if you're a resident of Missouri, you can contact my firm, Compton Advisors LLC. We can be found at www.comptonadvisors.com. Residents of other states can contact NAPFA to find an independent fee-only advisor. I recommend, even if you are a Missouri resident and visit our website, you check out NAPFA as well. You should talk to at least 3 advisors and find the one that's right for you. Selecting the right advisor is an important decision. I hope to hear from you. Good luck and good investing.